A lot of people are very concerned that the stock market is overvalued and due for a crash. But then there are people who are predicting the opposite, that it's going to keep going up like it did over the last 9 years. And if you look at this chart, you might not think so. Advisor Perspectives is a very useful website, and dshort.com. So when unemployment goes down and keeps on going down, that's a good sign. And now it's not looking like it's going to keep going down, but you can't really tell at this point if it's going to go up or go sideways. You don't know. So it's not really time to panic, but let's look at the valuation. The valuation chart here can be the way they did it. They averaged out the Cressmont PE, the cyclical PE10, the Q ratio, and the regression of the Standard & Poor's S&P 500. And as a result, they've come up with some very nice looking chart that shows that, like in the year 2000, it was highly valued. And then the subsequent 10 years, the return. So if you bought stocks in the year 1999 to 2000 and held for 10 years, what would your return be? It would be negative. And then look at 1929. If somebody bought stocks in 1929, well, stock market was going up, people were getting excited, but if you bought at that time, your return was negative. And then how about the times when people were not so excited about stocks, the valuation was very low. The subsequent 10 years return was very high. This can be used to predict the stock market, but it doesn't tell you if you're going to make money or lose money this year, next year, or the next couple of years, but it tells you over the next 10 years. So you have to average out your returns over the next 10 years to make this chart here well accurate. And then, of course, it can be used to predict the future of the stock market. And that's what I did. Now, I can't expect it to be perfect, but that's what I did. So I used the Android Studio and did some computer programming and came up with this kind of charts you see here. So the magenta line is the prediction of your, well, it is your expected 10-year return. The blue line is the actual 10-year return, and it's very close. So right at this point here, this is the current date, the most recent data. The valuation gives us a predicted return of 2.6%. And if you buy stocks right now, you can expect to make 2.6% plus dividends for the next 10 years. How about when it was close to zero? Well, then you can expect to get almost nothing except for the dividends for the next 10 years. And what actually happened was the stock market went up following the prediction and then hit the red line and came down. Now, what is this red line? Why did it react to that red line? Well, it didn't really react to it. This red line here is a shifted version of the global debt. So I used global debt. So I took the stock market, divided it by global debt, and came up with a chart and used that to make these predictions as this magenta line. Magenta line being the line that the pilots like to follow on their electronic course. And then I take every single point and make a prediction of the future because it predicts a return. So that means that right now, if we predict a 2.6% return for the next 10 years, it's going to be up here. So in 2029, it's going to be above 3,000. And if you go back over this entire history of the stock market and then make your prediction 10 years in the future based on this valuation, this is what it looks like. So it's not perfect. It's not perfectly predicting. There are times when there was a big difference between the prediction and the reality. But over time, it's pretty darn close, especially over the last 9 years. So the green line is the cheap line. It's also the a shifted version of the global debt. So I shifted it down to the lower bounds of the stock market and it shifted up to the upper bounds. So when stocks get down to this green line, it's cheap to buy stocks. So if the stock market crashes, you don't know where it's going to stop. But if it gets down to 1200, that's a good time to buy because that's cheap. Now it might crash down to zero, but it'll probably bounce up above 1200 and maybe somewhere in the middle. And if it goes above this red line, it probably will come back down. Now, it may not follow the prediction perfectly, but it will probably oscillate above and below it for the next 10 years. And why would the stock market go sideways for 10 years? Well, for one, the Federal Reserve is taking it easy. They're not raising interest rates really fast, and they're not cutting them and leaving them to zero. They're not stimulating the economy, and they're not crashing the economy. What about Trump? Is he going to raise tariffs so high that it crashes the economy? Probably not, because he's a billionaire and his friends are all billionaires. He doesn't want all his friends to hate him because of the crash in the economy. And China's going to do everything they can to keep their economy strong, because if their economy crashes, they're probably going to have a revolution. So you can imagine it is possible for the stock market to go sideways for 10 years. Now, how do you know whether or not you should be in stocks or in bonds or real estate? If you look at the valuation and it's predicting that you're going to have very low returns, then maybe you should go to cash. But is it time to go to cash? This app also has a timer in it. So when unemployment, that's the red line, when unemployment goes up and stocks go down at the same time, this here will switch to saying cash. It will turn red and the screen here will say cash. And it's right now, it's not rising. It's not going up. It's not rising. The unemployment might go sideways, but it's not rising. So it's not saying to go to cash. Even though the stock market hasn't been going up, it's been kind of going sideways to down maybe. But if unemployment does go up, this will say cash, and that could be a good time to go to cash. Most of the time, it'll just say S&P 500. That's when you should be in stock market, because most of the time, stocks go up. And if they are going up, this will tell you how much you can expect to make. And right now, it's not very much. So the app is available at Google Play. And it's called this S&P 500 Forecast Advanced. And it costs $100, but it tells you when stocks are expensive and when they're cheap. It tells you how much money you can expect to make over the next 10 years. And it tells you when you should go to cash if there's going to be a stock market crash. So it could save you much more than $100 if the stock market is crashing. It can also allow you to feel confident in making a lot of money if you're in stocks. And right now, when you shouldn't be so confident, it'll tell you what you can expect. So I wish you well, investors.